All right, we're live. Welcome back, everyone, to the MisterRentToOwn Homes Show. My name is Dominic Danino, aka Mr. Rent-to-Own Homes. And in this episode, we're going to talk about, can you really refinance without going to a bank? Today, I am joined by James Brown again. Welcome back, James. How you doing, buddy?
Hello, hello. Doing great. Let's do it.
All right, so this is a very interesting and different kind of way of approaching things, right? So let me first qualify this with. Oh, there we go. We got an echo. All right, so let me first qualify this and say that this is for the right individual and for the right situation. Not everybody's a fit for this, but let's talk about this because we've run into this situation a lot more recently, right? Probably over the last, I don't know, 6 to 12 months, we've run into this situation a little bit more. As it relates to people looking for a way to refinance, not because they don't want to go to a bank. Sometimes they don't want to, but it's because why not a bank? Is because banks have requirements, right? They have guidelines. They have credit score requirements. They have income requirements. They got the income documentation requirements. They need certain amount of equity, the right property, right location. So, so banks have these requirements that are just applicable the same way as they are for when you're trying to acquire a property, right? So for refinancing, and when we're saying refinancing, we're talking about situations where people need to pull equity out of the property. So, because of what's happened in the market over the last, 5 years or so, a lot of people have mortgages, first mortgages at good rates, uh, and they have a lot of built-in equity.
Right.
But maybe their situation changed from when they got that mortgage initially. So when they got that mortgage initially, they qualified and they had the credit and they had the income. But not everybody stays in the same job for the whole period that they have their mortgage, or their situation, their life circumstances don't always stay the same, right?
Yeah.
Sometimes stuff happens.
Yeah.
Sometimes people get sick. The divorce is a big one, right? So things happen. So now
Yep.
they can't go back to that same bank or that lender or go to their credit union or their local bank or whatever and ask for new money, right? And when I say new money is okay, they have an existing balance. Let's say a house, it's 500,000, and their current balance is 300,000. Well, they have $200,000 worth of equity, but let's say they want to I don't know, catch up on bills because they got behind. Something happened along the ways, right? Or I got to pay off the ex because we're getting a divorce, or we got a separation, or I got child support, or whatever that may be, and that comes up. So their situation has changed, so they can't always go to the bank and the bank say, "Oh yeah, we're just going to reapprove you for a new amount and give you new money," right?
Yeah.
Or one of the things that's hot right now is home equity loans.
Right.
Right? Home equity loans, it basically, for those of you who don't know what that is getting a new loan on top of your existing one, right? And you're going to have two separate payments because you're borrowing a portion of that 200,000 equity that you currently have, right? So in our example, you have a mortgage 300,000. Somebody says, "Hey, can I borrow 50 or 100,000 out of that 200,000 equity?" So you go to the bank, credit union, whatever it may be, say, "Hey, can I get a home equity loan?" So meaning I just want to borrow a portion of that equity using my house as collateral, right? And yes, I realize I'm going to have a second payment, but I'm going to take that money, either do home improvements, pay off bills, maybe my old beater died and I need to buy a new vehicle because I got to get to work, right? And maybe
Yeah.
I'm not in a place where I can do public transportation or whatever, or it's just inconvenient, or you got kids to get a haul around, and right, not necessarily haul the kids around and ride them around and take the local bus or whatever the local transportation you have, right? So many of these things happen,
Yeah.
and there's
Life
a need.
happens. I mean,
Yeah,
your
that happens a
equity's
lot.
locked up. Yeah.
So is a situation where somebody has a need to borrow money. And maybe their situation has changed credit-wise, income-wise, job-wise. Maybe they were a W-2 employee and 5 years ago when they got the mortgage, but now maybe they left that job or got laid off, maybe started a new job, or now they started a new business and now they don't qualify traditionally because their situation is different. So this is an instance where somebody has a need, they have equity, but they can't access it, right? So they're not accessing it because the bank is saying no, right? And everything that we talk about and that we do is geared around that aspect of traditional versus non-traditional, right? Traditional world requires in the box kind of thinking, and you gotta fit into this box with certain guidelines from a lender's perspective, right? Well, not everybody lives in that box world of the banks, right?
Yep.
That's just not the reality of the world that we live in anymore. So anyway, so somebody has a need, they go to the bank, the bank says no. So now they're like, okay, I feel like I'm sort of stuck, right? Or they feel like they're sort of stuck and like, well, what are my alternative methods? So generally to me, it's somebody that has a need. And that's why I qualified it initially with saying, hey, it's this scenario, this situation is for the right individual, for the right situation. It's not for everybody per se, right? Because alternative methods aren't going to be your cheapest method, right? It isn't like, oh, I go to the credit union, they're going to give me 8%, but I don't qualify, so I need an alternative method, and my alternative method is going to be 2%. That just doesn't work that way, right? Right?
Right.
It's the reverse. So it's not going to be the cheapest option, right? Doesn't mean it's not the right option, because reality is cheap doesn't always mean better. The cheapest doesn't always mean better, right? It's what you need now,
Yep.
right? And sometimes we understand this, having being in the creative space and working with investors. Investors don't pay the cheapest rates or the cheapest costs, right? But they understand their numbers or what they're trying to accomplish, and they see the investment, even if they're going to pay a little bit more higher costs to borrow or whatever that may be. That's going to in turn create a situation or a deal or profit on a deal that's going to more than offset that higher cost, right?
Right.
And so while this may in this situation, when it comes to like refinancing for a situation where somebody needs the money, it may be for an investment opportunity, could be, right? And we see that on the investor side, but it may not be an investor opportunity. Maybe somebody, like we said, one of those scenarios where somebody just has the need, and but they're not able to source it from a traditional method, like a bank, credit union, or whomever has their existing loan, right, to do a traditional cash out refinance or get a home equity loan. So there are alternative methods in potentially accessing some of that equity, and we're going to talk about those. But I'm going to let you jump in because I kind of introduced the topic here and when these scenarios come up, and you could talk about some of your own experiences in a few situations like this where you run into this, and what kind of need or why did they need it, or who was this for, and when did this come up for it?
Yeah, you explained that really well. What comes to mind is one where we had a gal that had a beautiful home on the East Coast, and we can do this in any state, by the way. She had a job. She was switching jobs, but had a good job. Had bought a truck. She just had all this equity lined up or locked up in that property. She wanted to pay off the truck, pay off some debts. Actually had taken a personal loan from somebody, wanted to pay them off. And so you jumped in and figured out how to structure that. And I was, I was blown away by how you figured it out. It was really cool. But anyway, that was a perfect example of somebody that had multiple things they wanted to pay off, but had that equity locked up.
Yeah. So in that particular situation, the individual had gotten a new job that was a commission-based job, right? And it
Right.
was their first time being in a commission-based job. So they don't have a history to go to a bank and say, hey, can I borrow? And this is my traditional income that I have had tax returns for 2 years, and I got all the documentation. In addition, her credit wasn't the best either. So even
Right.
if she did have that, credit was an issue,
Yeah.
right? So again, two boxes that she didn't check with traditional banks,
Yeah.
right? But she had a free and clear property because she had paid cash, and so we got the cat in. Anyways, so she had
We have a
paid cash
special
for a
guest.
house because she had inherited some money, or she had come into some money, and she thought, oh well, the best thing for me to do is just pay cash for a house. It's great, right? You know, having no payments, but it doesn't let you do a whole lot of things if you don't have additional income to it, right? And I
Yeah.
think one of the things that may have come up was potentially, okay, well, if you don't have income, or you're working on getting income, or you're new to what you're doing, you don't have a steady source, or you don't have a way to verify a consistent income. Issues that could come up is, well, you paid cash for a house, but how are you going to pay the property taxes? How are you going to pay the homeowner's insurance or the insurance? Now, when you borrow from a bank or a lender, they require you to get insurance on the house. Most people don't even realize this, right? Banks require, and most people think, oh yeah, carrying insurance on your house is normal. Yes, it's normal because when you borrow, they force you to get it.
Right.
But let's say you didn't borrow and there was no loan on it, you're not required to carry insurance, just like you're not required to carry medical insurance, right? Maybe it's provided through by your job, or you're signed up through a private health insurance program, or whatever that may be. But nothing
Right.
says you're required to, right? Same thing, requiring insurance on your house if it's free and clear. Nobody has an invested interest to make sure that if the house burns down, they're covered, right? Because there's nobody that has any interest in your property other than you. So technically, if you want to roll the dice and carry no insurance, you could technically do that,
Yeah.
right? And speaking of that, I mean, running into, or what's happened down in the Southwest, I'm sorry, in the Southeast, with the hurricanes and the impacts of climate and weather has impacted insurance rates, and insurance carriers either leaving or charging more, or not offering insurance in certain locations, and the
Right.
cost of that insurance has gone up. And I know some investors that have portfolios of properties. I'm not talking about just ones or twosies here. They're doing 10 or more, and they've decided, instead of spending money to carry those insurance or pay for insurance, they basically are self-insuring, right? So that's
Yeah.
that's a high risk, but that's for the right individual. Somebody has the pocket to be able to withstand that potential risk, right? And let's say they have 10 houses and they got to pay, I don't know, $20,000 a month in insurance, basically, or 20,000 a year, or whatever that may be, right?
Yeah.
And so they're saying, hey, I'm not going to pay that. I'm just going to set that aside in some other account in case something happens with one of these 10, right? And I'm sort of playing roulette, or actually, it's a risk analysis, right? And in the financial industry, that's stuff that's um, calculated or analyzed, and insurance companies do this themselves, right?
Right.
They're
Yeah.
looking at, hey, we're carrying 10,000 policies. What is the likelihood that we're going to have to pay on one of these 10, or a portion or a percentage of these 10,000 while we're collecting premiums,
Yeah.
right? And
Yeah.
then that's how they assess their risk and increase either how much they charge or how little they charge, or whether they're in a certain market where, let's say, out of those 10,000, they're having to pay 5,000 claims. Now it just doesn't become cost. It's cost prohibitive, right? They're losing money. They're paying out more than they're taking in. So they make a decision to say, hey, we're not longer going to insure in this zip code or this area, this zip code, because our history is showing over the last, I don't know, 10 years, it's been incrementally increasing the amount of uh, money we're having to lay out, which is more than what we're taking in. So they make those decisions. Somebody could do that too. But anyways, back to our original example, this person could not carry insurance if they didn't. But if the house burns down, they have the land and whatever's left over of the house, right? So this is a situation where somebody was equity rich, but cash poor,
Yep.
right? So they were looking for a solution to somebody say, hey, I want to be able to pull out this equity here, but I can't get qualified by any banks to do that, right? And I need, let's say, I need a year's worth of what my income would be, so I can have a reserve in the bank in case my income fluctuates while I'm getting up and going on this commission-based job, right? So let's say 1 month I do good and 1 month I don't do good, but at least I have a reserve to kind of get me through this ramp-up period. Because anything that you do commission-based, takes a little bit of a ramp-up period. Most examples, or a new business, right? Typically, you're going to need at least maybe 6 months of ramp-up when you're going to be 100% commission or new business, right? And you agents out there and lenders that work 100% commission, you understand this, when you first started, right? There's a ramp-up period. You just don't start making money the first month, right? So this is a situation that somebody needed some equity out of the property and was looking for an alternative way to be able to access some of that equity while not being able to get it from a traditional lender, right?
Yep. Yeah, that was a perfect example.
Yeah. So let's talk about what are some of those alternative methods to access equity. So some of the methods that we understand is there are non-traditional lenders or what we call private lenders, right? So let's define what a private lender is. So a private lender is typically not an institution or not a depository institution, right? Like a bank that has you walk into a building and put in into a savings or a checking account, right? So typically a private lender is somebody that's not a box lender or a box bank, somebody that has money to lend, right? And they're going to lend in the right situation. And they're typically lending to people that don't fit into the bank box. But for that particular scenario, they're going to charge more, right? Because they're assuming a greater risk because you don't fit into that box. So the likelihood of you repaying is probably less than somebody that has 800 credit score and they've been working at their job 10 years and they make $100,000 a month and they have all the stability in the world. Well, they're lending to people that don't have that kind of stability, and they're going to charge accordingly. They're going to charge potentially higher rates. They're going to charge some points, some fees, and so forth. But it's going to get you what you need for the moment. And then down the road, what you can do is pay them off or refinance once you fit into the lender box and go back to the lender box and say, hey, now I fit into your box. Can I borrow back at cheaper rates? And I don't need that other loan, and we'll pay that off. And now I'm back to my old traditional method, right? So private lenders, and there are a few, I wouldn't call them institutions, but they're funds, right? We talk about funds. So basically, pools of capital, right? So some companies, there are some lenders that manage an amount of money that they pooled from private investors into a bigger pool, and then they're handling any potential transactions, and they're the responsible party for creating the terms and lending out and vetting who they're lending to and setting those standards and collecting on those payments and making sure they get paid back. So all that money and profit goes back into the pool, and then that pool pays back whomever invested into that pool with interest or whatever they promised them and so forth, right? So that's what we call a fund, right?
Right. Yeah.
And typically people that are investing in those funds are going to be what we call accredited investors, meaning people that are more financially savvy. It's not going to be your average consumer. They understand the risk. They have the capacity, the assets, the experience to be able to invest in that. Because if let's say they put in 100,000 in it, if they lose the 100,000, but their net worth is 100 or 10 million, then the 100,000 lost isn't a big impact. They're not going to be homeless, right?
Yeah.
So only certain people that fit into that accredited investor box can invest into those kind of funds. They're getting a premium on their money, right? So the higher the risk, the higher the premium that people usually collect. It's just a risk, right? From a lending perspective, for all you lenders out there, you understand that, right? The higher the risk, the higher the rate, and you as a borrower, the higher the risk you are, more than likely you're going to pay a higher rate or higher premium or higher cost in that borrowing, right? For whatever purpose you may be using. So those are some alternative methods and ways that people get access to funds to be able to do whatever it is that they have a need for at that moment, right? So another method that we implement, we have access to, is basically do a private transaction where we buy the property and give them the equity on that property, right? Give them the money and then we give that individual an opportunity to buy back the property from us down the road once they've met their in the box requirements to go borrow new money and then just basically buy the property back from us, right?
Yeah.
So we have access to private investors that will do that along with us, and then we're doing the vetting, and we have to set a plan in place that makes sense for everybody to say, hey, uh, uh, yeah, we're going to give you a year, 2, 3, 5, whatever it may be, to kind of get reestablished and go borrow, right? But you got to go do your part and get this cleaned up, or get your income in line, or your taxes in line, your documentation in line, fix up your credit if credit is a situation like that, get that resolved, and then we'll give you the opportunity to buy the property back from us. But we're giving you access to some of your equity now, right? And obviously, when you buy it back, you regain the majority of your equity minus any cost to do the transaction, right? So that's a different and creative way of doing it. If we look at those as a plan B or a plan C situation, right? Obviously, like, again, your cheapest way to access equity or borrow is going to try to qualify a traditional lending institution, but they will have the requirements, and if you meet those requirements, great, by all means, that's where you should be going, right? But as a plan B, could be a private lender, or a plan C, it could be a transaction where we step in as somebody that's buying a property and giving you your equity to use now, and then come back and be able to buy the property back from us.
Yeah. Yeah. I love it. It's very similar to when somebody doesn't have a home and wants one, and we can help them, and
Yeah.
kind of, yeah, gets the
Yeah.
same
So
goal.
so so I want to talk about another example of somebody in that particular situation. Um, right. So in the one scenario that we just talked about, right? That was some individual. So another one that just recently, we had somebody that happens to be an agent. They have a house with equity in it, and for you agents out there, income fluctuates, right? Your income fluctuates from month to month, and so you're gonna have great months and maybe not so great months sometimes, right? And or stuff happens in your life too, right? And you need to access that equity. But say either you haven't done your taxes, or you wrote off a lot, or you didn't make as much, right? So traditional lenders are going to look at your income history, and they're looking for stability. Let's say in 2020 you made 500,000, in 21 you made 500,000, but in 22 and 23 you made 200,000, right? The bank doesn't take the average of those four. They don't take the high and the low. They're going to take the lowest. And if you went 500, 500, 200, and then 100 in 2023, they're going to say, we're not even going to average the 200 and the 100. They're going to say, we're going to take the lowest because we see a downward trend and we see a problem here, right?
Yep.
So
Mm-hmm.
now you thought you thought, oh, I make 500, or I have a history of making 500. But the bank isn't going to look at that. They're looking at, we see a downward trend, or we're going to take the lowest trend, right? Because banks take the most conservative approach to qualifying you on anything that they're going to lend on,
Right.
right? They are so risk adverse, um, and that's why we have this situation in this country where 70 to 80% of the people that want to buy a house can't qualify because they don't meet traditional bank standards.
Yep.
Right, and that's where we come in. Anyway, so in this instance, we had an agent has a lot of equity in his property and was looking to access that equity. Right. One of the things is, hey, you wanted to pay a couple of bills off and kind of put more marketing into his business. Right. So you agents are business owners. Don't forget that. Right. And you got to generate business and market, and you're going to have to do some investing in your business, just like anybody, just like the Chinese food restaurant that has to buy equipment and the ovens. Well, your equipment is your lead sourcing, your marketing, right? Whatever that may be, your CRM, if you're doing paid ads, if you have a social media team or assistant and all these things, right? So you got to invest in your business. Well, in this situation, the agent, and based on the changes in the market, felt like, hey, I think it's time for me to crank up my marketing, put some money into my business from the equity that I have in my house, because I feel like rates are going to start to drop and we're going to get a pickup in business. And I think I want to get ahead of that. And I want to invest in my business and take advantage of the opportunity while everybody is sitting on the sidelines waiting for something to happen. He's looking to make it happen, right? Yeah. So that's a very proactive approach to thinking about. Otherwise, you just as well go get a W-2 job, right? If you're not looking at it that way, if you're not looking at your business, how do I grow it? How do I keep momentum? How to create momentum if you're totally stalled?
Yeah.
Right. So anyway, this is an individual that understands what we'd be doing in his situation, right? This individual sends me leads of clients that don't fit into the traditional box and understands our program for his clients and now for him.
Yeah.
Right. So it's a win-win in the sense that, hey, he's getting what he needs now, right? And looking for the opportunity to kind of like bring up his level of income and generate more business to be able to say, okay, I'm back to normal. Now let's go do what I was doing already. Yeah, so it doesn't have to be somebody that's that may be perceived as in a financial stress situation. Somebody that's just trying to be proactive and thinking, hey, I crunch my numbers, and if I borrow this and this is my cost, and I'm going to generate this because I'm going to put in the work, right? It isn't just, okay, I got the money and I'm going to go to Vegas with it. I'm going to invest it in my business. I'm going to put in the work. I got to do what I got to do, right? My marketing, open houses, whatever it is, generate more lead sources and work those leads as effectively as possible. And right, again, doesn't have to be agent, but any business. Then yeah, they see the opportunity, they see it, or they see the ability to do this as a way to kind of get themselves ramped up again, or going again, or kind of being proactive and getting ahead of what's to come, right?
Yeah.
Any other scenarios that you run into? There's another one I want to talk about, right? Okay. There's a scenario I think we have done it, or you have done it. Was it during COVID when somebody has like the couple that had a lot of equity but got behind on their payments during COVID?
Mm-hmm.
Right, they had a lot of equity. Well, they couldn't qualify for getting a home equity loan to pay off the collection bills that they got behind while they were sick during COVID, or it wasn't going to be able to refinance.
Mm-hmm.
Right, so they sold the property, pulled the equity out, paid off all the bills, and used the equity to get into a new house. Right, and they did a rent to own on the new house because they had the equity, but they weren't going to qualify. They realized that we're not going to qualify for a new traditional financing, but it doesn't do us any good to have all this equity in here when we can't move forward. And they got collectors calling them, right, on stuff that they can't get caught up on. So sometimes you need a chunk of money to get caught up on to stop those calls and kind of do the reset button. Basically, it's like, okay, I'm back to work, everything's back to normal. I'm okay. I'm not sick anymore. COVID is over. I want to kind of put the reset button on my life and kind of move forward and start from scratch. But no, this gives me the opportunity to use that what they've built, right, in the sense, because they built the equity in the sense, right, because they bought the house, and they took advantage of the opportunity. The values went up, and take that equity and gets me out of this bind, gets me out of the situation. If they didn't have that, they'd be in bigger trouble, right? But they'd say, hey, we're going to use some of this equity, let's pay off the bills, let's pay all the collectors, all this stuff. That way they leave me the heck alone. I can go about my business, and I'm not be stressing about getting all those calls. Take that money, pay them off, and then let's find me a new house that we can do rent to own on.
Yeah, we actually did 2 of those.
Exactly.
Very similar situations. Didn't want to keep the original house. We're like, okay, go pick out a different one. Perfect.
Yeah, and this, not just for this individual, but let's say you're an agent, right? So if you were an agent, how would you propose this? Or you may get clients, and I get agent calls calling me and say, hey, I got this situation with this individual. Either they can't sell the house, or they can sell the house, or they would like to sell it but stay living in it, right? But they want to get access to the equity and they can't get it home. So usually what happens, consumers are calling agents to see, hey, I got this situation, this is what I got going on, what can you do? Right? You guys are the first point of contact, or a lender friend if they happen to have a lender friend, but you guys tend to be the point of contact because you're the one that helped them buy the house. Right. And if you're an agent and you get those kind of calls, and you don't know what to do with them most of the time, right? Most agents wouldn't know what to do with them, right? But being able to have on your Rolodex people like us to say, hey, this is the situation I got with somebody, a client. I don't know what to do with it, or I don't know what we can do. As a matter of fact, I have another agent that she markets to no equity, low equity, or negative equity properties, right? Mm-hmm. As a way, if somebody's looking to sell, but they have either no, little, or negative equity to sell their properties.
Yeah.
Right. So usually, because there's a cost in the transaction and selling and paying a commission, we can do that creatively, where we can pay that agent even though it's not coming out of the equity, and basically, instead of that individual that has to go somewhere, or maybe they're behind, give them the opportunity to save their credit. Right. Yeah, and if they let it go, and for whatever reason somebody has to come, the bank has to come get that house, they're not going to qualify for. And if you have that, you're not going to get an apartment either, right? Apartment, when you apply for an apartment, you need a 600, 660 or 640, some kind of credit score. And if they see a foreclosure, they're going to say, well, you couldn't pay that. How are you going to pay us?
Yeah.
Right. So where are you going to go? Where are you going to live? You're going to go live with family. So yeah. So this is an opportunity. If you have somebody like that, you can reach out to us. We can kind of run by the situation and see if there's a solution to be able to save them from having that on their credit. Right. Now, they may not walk away with any equity because there wasn't any equity to be had. Right. But the opportunity there is to at least, hey, let's save your credit.
No.
Let us make the payments on that house for a period of time to kind of, yeah, you got behind, you're behind 30, 60, 90 days. Let us pay it for a while. We'll take it over. We'll take over the payments. We'll take it over. And then down the road, we'll sell that house and pay off that loan. And then that'll come off your credit. But you're going to have to reestablish good history on that to be able to qualify for a house down the road, or at least be able to get an apartment if that's what you need to go do. But if you just let it go, then that's going to be a bigger problem, right? So that's another method that we can help people that are in potentially that situation. So yeah, so I have an agent that I'm working with. She sends out direct mail on that.
Yeah.
And so we're working together to see if we can help more people.
Yeah, that's great. Yeah, sometimes you just got to stop the bleeding, and not just throw your hands up, come up with a solution and look down the road. Yeah.
Yeah.
For-
I mean,
for
and a lot of times people kind of feel bad about that, being in that situation, but I mean, there's nothing to feel bad about, right? I mean, stuff happens, right? The term we use is bad stuff happens to good people,
Yeah.
right? It isn't intentional or stuff happens, job loss, sickness, car accident, divorce, whatever that may be. Stuff of stuff that happens to people all the time, right? And is it intentional and it isn't you did something wrong. It's just life.
Yeah.
Life events, right? Life events will happen, are going to continue to happen. But working with individuals like us that may have a creative solution that's just not the traditional way, that could provide you some options. And maybe our option isn't right for you. That's okay too, right? It's like, hey, here's the things you can do. No, you decide what you want to do, right? What's the best one, or what's going to solve your problem now, and what's this going to look like down the road too, right? Not just the immediate, but what is this going to look like down the road for you, right? Hopefully, to give you an idea or kind of a plan in place for you to go ahead and kind of get back on track to more of a normalcy, basically, after you've gone through this life event.
Yeah.
All right. Any final thoughts? Any other scenarios you want to talk about?
I think we covered a lot of ground. Hopefully somebody's watching this, they think of us when they run across a situation like that, or any of these situations, because it's not just one that we talked about, so.
Yeah. So to close out with that, right? So if somebody wants to get a hold of you, how can they get a hold of you to work with you, right? So I kind of zoomed us in with our contact information on the live there. So for those of you that are not watching us on the live or watching the video, and are just listening to this broadcast or podcast, how can I get a hold of you?
I just go to linktree.com, then /partner with James Brown.
All right. And for those of you who want to get a hold of me, have a scenario, want to run a situation by us or by me, you can get a hold of me. I am on Instagram and TikTok at MisterRentToOwnHomes.com. And our website is rent2ownhomes.us.com. That's our rent to own home website. You could put in your information in there if you're interested in our rent to own program. Or you can reach me on my email or phone number in my bio on all of my socials. And then we can hop on a call and kind of go over your scenario, whether it's you, the individual that needs the assistance, or if you're an agent or a lender that has a scenario with a borrower or a client that maybe you don't know how to resolve, but at least you need a second set of ears to kind of bounce ideas off. Maybe we can come up with a creative solution for you. All right, that's it. Thank you all, and see you next week. Bye-bye.